Hey guys, welcome back. In this video, we are going to talk about the fourth largest iron ore producer in the world, Fortescue Metal Group, with the ticker code FMG. Goldman Sachs has recommended to sell FMG with a target price of $11. That means the share plummets by at least 45% from the 10 years high from $26 down to about $14. FMG price drop is obviously due to iron ore price dropping from about $200 per ton down to about $90 per ton within the past 3 months. And on top of that, there's also Chinese property developer Evergrande that is unable to pay interest to the bondholders. And then if you carry on, there's a story about Chinese property bubble, Chinese ghost apartment, that maybe a Chinese economy is a bubble after all. But the fact that the past 3 years, the Evergrande stock has been punished and has been dropping in value of at least 90%. Aside from a lot of news, noise and speculation, in this video we are going to do a 10-year review of Fortescue Metal Group performance and also to see the impact of iron ore price to FMG profitability. And after that, we're trying to make sense. Is it reasonable for people to buy FMG shares at $26, $17, or even $14? And then we're gonna finish off with some comments about Fortescue Future Industries. I'd like to say thank you to Sam for requesting our opinion for FMG 50% pullback. Let's start with the iron ore produced by FMG. From 2011, FMG has shipped 40 million tons of iron ore. Last financial year, 2021, they have reported that they have shipped 182 million tons of iron ore. So they have definitely increased their production for at least tripled. And if we look at the C1 costs are mining, processing, rail, and port costs. They have reduced it from $48 per ton in 2012 down to below $15 since 2017. As you know, lower C1 cost, that means higher profit margin. An increase of production at that level and also reducing costs is definitely an Australian innovation, but that comes with the huge costs. They have borrowings that is really high. Prior to 2017, the borrowing goes as high as over $12 billion in 2013. And high borrowings would also means higher finance expense. So prior to 2016, people are really worrying with the debt position of FMG. If you look at it in debt equity ratio, in 2013, the debt to equity ratio is over 220%. But in saying that, ever since 2017 onwards, it has been below 40%. So they are in a lot better capital position. And we can see the effect of increase of production and lower C1 costs. The dividend from 2017 onwards has been very high because of the higher profit margin that they can achieve. However, if we look at in 2015 and 2016, the dividend is the lowest of the past 10 years, as low as 4 cents US dollars per share. And why is that? And obviously the share price is punished by 70% drop from $5 in 2014 down to $1.40 in 2015. And the answer is obvious. Iron ore price in 2015-2016 has suffered for the 10-year low. The realized iron ore price for FMG in 2016 is as low as $42 per ton. At the moment we are in about $90 per ton, so it's somewhere around the level of 2014. But the financial year 2021 is the 10-year high of the realized iron ore price at the high $130 per ton. Now let's get back to the original question. Is $26 per share justified for FMG? The answer is yes and no. It depends on your projection of the future cash flow. It really depends on the price of iron ore that you assume gonna be. If you assume iron ore stays at $200 for the next 5-10 years, then $26 makes sense. But the fact is, nobody knows what the iron ore price is gonna be. It can drop to $40 tomorrow, and the executives have no idea. They can only prepare for the worst. And a wiser idea is also when you invest in iron ore company, you should be prepared when the iron ore price plummets to as low as $42 like in 2016. Our estimate is that if the iron ore price drop as low as $42 per ton, FMG still can make a profit after tax about 2.5 billion. That's about 83 cents US dollar per share, earning per share. And luckily we've done a 10-year review. We get a number of 10-year average price to earning ratio about 8. Lower than BHP with the average PE ratio about 12 because they have other minerals such as copper that they have. 83 cents US dollars earning per share times 8, that is about $6.60 US dollars, or in Australian dollars is about $9. Worst case scenario, if the iron ore price drops as low as 40, potentially it can go as low as $9. Not far off from Goldman Sachs target price of $11. Again, it really depends on your return expectation. And also the estimate of profit after tax about 2.5 billion. It really depends on the capital expenditure that they're gonna use for the next 5-10 years. They have projects such as Iron Bridge project that will increase the iron ore production by 22 million tons per year. In saying that, if you increase supply, it will reduce iron ore price, right? And from the annual report, they say the C1 cost for mining Iron Bridge is higher than the company's average. It's about $30 to $35 per ton. And aside from iron ore, FMG also have exploration projects on copper gold in various countries in South America and even Kazakhstan. Now for the last part of this video, Fortescue Future Industries. Andrew Forrest, the chairman of Minderoo Foundation, the company that essentially owns FMG, has presented his Boyer lecture, A Confession of Carbon Emitter. It is an interesting lecture. I think you should watch it on YouTube because it is obvious that the mining industries in Australia are the ones that emit carbon the most. In response to that, Andrew Forrest is doing an action. He started this FFI that produce a lot of mining trucks, equipments, trains that run on ammonia, or even shipping that runs on ammonia, in the hopes that it will achieve the net zero carbon by 2030. In my opinion, in terms of profitability, whether it will increase their profit after tax, I don't think it will affect that much. But I believe that it will impress China a little bit more because China is trying to cut their carbon emission too. So they might prefer FMG iron ore compared to other suppliers. So in conclusion, you need to measure your risk that you're willing to take and measure it with the reward that you will get. What sort of your expected return? And of course, you need to prepare for the worst. What if the iron ore price dropped to even $30 per ton? Thank you so much for watching. Thank you, Sam, and I'll see you in the next video.